Welcome back to part two of the Cockroach Series. I'm here with my partner, Jason Buck. I'm Taylor Pearson. We're going to be talking about a lot of fun topics today. Get excited. We got sequencing risk, ergodicity, retirement planning, all the hot topics of our day. But as we've said before, this series is us talking through some of the research we've done and our thinking about portfolio construction over the last 5 or 10 years as we've thought more and more about it. And today, we want to talk about some of those sorts of things. And I think we want to start with expected value. I think probably most people listening are familiar with this topic, but the rough idea here is that expected value is multiplying the probability of some outcome times the payoff of some outcome, right? So, if you are rolling a dice, and let's say if you roll a 6, you win $10. You bet $1 to win $10 if you roll a 6. So your expected value is your probability of winning. So in this case, 1/6 times the payout, which is $1.66. So you bet $1, your expected value is $1.66. This is great. A lot of people would like to make this bet, and I think I want to talk about this because I think for the most implicitly and to a large extent explicitly, like expected value is how most investors think about portfolio construction and picking assets. That's they're looking at, do I like this stock or that stock? Do I like this fund or that fund? Do I like this asset class or that asset class at any given point in time? And they're doing sometimes explicitly, I think a lot of time implicitly, some sort of expected value calculation that I think this is going to do well or I think this is going to do poorly over the long run. And I think there's a few, as we talked about, some nuances around how people think about stock market investing. I think some nuances around how people think of expected value that we want to talk about here. So,
And like you said, this is our sweet spot. So you're joking about it, but this is what we talk about all day, every day, and why we build portfolios around ergodicity problems. And like you said, I think like you said, people understand EV because it's like more of a betting scenario for discrete events. So it does make a lot of sense. But I think speaking of betting, like I think Nassim Taleb popularized the idea of like a casino, right? If you had, everybody going into a casino, and this is the way to talk about ergodicity in a more simplified version, is the ensemble versus the path or time or singular approach, right? Like if you have 50 people going in to play a casino game and they have a positive expectancy or positive EV like on those bets, but you have a chance of risk of ruin, if 50 people play at the same time, the one person risking ruin doesn't hurt you. But if you went into the same casino and played 50 times in a row and you're compounding your winnings every time, well, as soon as you hit that absorbing barrier, you're going to lose everything. And so, you brought it up last time, but I think the much more, we don't like to be macabre, but I think the best example is the Russian roulette. So I'll let you hit the Russian roulette again, because that's much more visceral and than thinking about 50 of your friends going into a casino.
Yeah, so we mentioned this last time, but just to briefly recap. So I think we'll create some terms here. So let's call one sort of an ensemble scenario. So you have an ensemble of individuals that are taking some action, making some bet in this case, and a path scenario, which is you have one individual that's doing something over the course of time. And so, yes, the fun example is certainly Russian roulette. 6 people play Russian roulette. This fun post-purchase survey, right, for 6 people playing Russian roulette. 5 out of 6 think it's a terrific game where you win lots of money and is very enjoyable, and they would recommend it to anyone. And 1 out of 6 people does not respond to the post-purchase survey. By contrast, in the path scenario, one person plays 6 times. There are no responses to the survey. The person does not come out the other end. And as Jason said, there's a number of other sort of examples to talk about this, right? If you have someone with edge in a gambling game, some counting cards in blackjack or whatever, and you have 10 of those people go into a casino versus one person go in 10 times, those are going to receive different outcomes. One person playing overtime as opposed to 10 people playing once, because as Jason was saying, one person, if you have 10 people and one person goes broke, that can be okay, right? The other 9 might do very well, and so your average could still be good. If you have one person playing 10 times and they go broke on day 7, they're broke, right? The sort of it drops off as a absorbing barrier, I think, yeah, is the fun term, right? But going broke is the more maybe the more
Yeah,
descriptive or
we have to
the
get
more
better
fun
at that,
term.
right? Like and I'm usually the biggest party foul on this. Is like I love, learning new vocabulary words. So obviously I love ergodicity and non-ergodic systems, but like we always are trying to get better on using different examples and different words, like you're saying, like the ensemble approach versus the individual path or time approach, but like we can get better, like going broke versus absorbing barrier. So yeah, we can always get better about these ideas, and we constantly strive to and try to come up with different ways of saying it. But I think historically, like we said in this essay too, it's like sequencing risk. Is that the way people talk about, your time horizons of when you're making money in your younger years, but then your prime earning years in your 40s and 50s, and then your retirement years, is like that sequencing of events affects what your total outcome is going to be and what your income is going to be in retirement, especially when you have those mandatory withdrawals. But I think one of the best ways examples is, shout out to Resolve Asset Management, is the idea of Nick and Nancy going into retirement. And maybe you can like kind of simplify it versus, whether your returns come early or late in your own life cycle of going into retirement over like a 30 or 40-year time horizon.
Yes, I think a descriptive example here is if you look at the Dow Jones Industrial Average, the returns from the period of 1966, 1997, so roughly a 30-year period, 31-year period, the average return was 8% over that period. And so, if you were to draw sort of a naive extrapolation of, I have $1 million today and it compounds at 8% per year, how many dollars do I have? In the future. Why this is an interesting example because from 1966 through 1982, roughly the first half of that period, the returns were close to zero. It basically ended up roughly around where it went, and then from 1982 through 1997, the returns were about 15% per year, right? So you had an 8% average over this whole time period, but if you sort of splice that time period in half, you had two very different outcomes. And so, we originally got this example from, as you mentioned, Resolve Asset Management. They have a great blog post on this. But you take a couple, Nick and Nancy. Nick and Nancy are 63 years old. They've accumulated $3 million in savings, which is great for them. And they're ready to retire. And they're expecting that their lifestyle costs are $180,000 per year. They're going to factor in a 3% increase per year for inflation. And if you just sort of draw the averages out for there, let's say they're retiring in 1965 in this example, and you just take that average 8%, their assets last them until 1997. So they're going to be 95 years old. This seems like a reasonable sort of period. But the order in which those returns come matters quite a lot. So if they get the actual returns over that period, starting in 1966, where you're basically flat for the first half of that period, they go broke in 1977, basically 12 years, right? Because what happens, they're drawing down every year as they pull out of their retirement savings. And it's not growing, they're taking their 180,000 plus 3% out. And it's depleted after about 12 years. Take the opposite scenario. Let's say they retire and they get the best period of returns first. They get really strong returns. What's starting in that 1982 period. Well, now, even as they're drawing down, their wealth is growing, right? So they're withdrawing less than it's compounding. They reach over $12 million in assets after they've been retired for about 15 years. And then they slowly draw down on that. So let's say they die at 95, they have over $6 million in assets. So more than when they started with, and whatever, great outcome. Of course, this is the same returns, right? Just delivered in different orders, right? In both of these
Different
cases, they were
sequences.
investing something that had an 8% average return. So I think, it's an interesting thing. I think it's something, people close to retirement. It's particularly relevant, right? Because, you can be in the Nick and Nancy situation, you need to think about like, what is the sequence? And we'll get into more. So I think that's, start thinking about diversification. How do we reduce that sequencing risk, right? That we don't necessarily need to have as high returns, but we want to reduce our sequencing risk. I think the other sort of simulation we ran here that I think is is maybe more interesting to me is what if you're a relatively young person? Let's say you're 34, 35 years old, you have $100,000 in savings, you're working a job, maybe you're adding 1,000 a month to savings. How does the sequence of return risk affect you then? This would be a fun thing to, yeah, again, pull, but I guess what the answer is, but I wasn't particularly confident actually. I was like curious to see what happened when it came out. What it comes out to is it's the opposite of the retired person. So if you get the returns late, that's to your advantage, right? So you have this flat period early on, but you're working that whole period, right? You're not drawing down from the portfolio, you're contributing to the portfolio. And even though it's not really growing, you're building up and you're building up a capital base. And then once you've accumulated a significant amount of savings, you get to this period where the returns start to get very good. It grows very quickly. And in this scenario I gave, starting with $100,000, adding $1,000 a month, you end up with a little over $3 million, like some $3.2 million. I'm eyeballing the graph here, which is pretty close to the average portfolio. The average works out to something like 2.9 million. Now, if we flip the sequence, you have very strong returns early on in your career, or relatively early on in your life, let's say in your 30s and 40s, and then you get flat returns later, you get a very different outcome. So again, run the same sequence. You take the 1982, 1997 strong period of returns first, and then the flat period. After that, your wealth peaks at around $1 million, right? And then it's basically flat at $1 million for like the last 15 years of that period. It's growing a little bit as you're increasing it, but you're not getting any of the returns, right? You were compounding off a relatively small capital base, right? You had relatively little savings. You're relatively early in your career. And then you hit this flat period where all of a sudden, you're looking at retirement or whatever your savings are at that point. And your average prediction would predict you'd have $2.9 million, and the actual number is going to be less than $1 million.
For those of you playing at home, I think it's fascinating to think about, like, we don't want to get in these okay boomer scenarios, but if you think about the baby boom generation, right, the last 40 years, they've had pretty solid, steady returns, right? And do we know then, are they going to go through a flat period for a decade or two now that they're in retirement and have those mandatory withdrawals? It's hard to know, right? Hard to know a priori. And then the flip side of that, if you're 30 years old now, what's your expectation moving forward? Do you think you're going to have a good as good 40-year run in the 60-40 portfolio that the boomers had just went through as they were, building up their savings in their prime earning years, contributing more and more? Meanwhile, they're clipping along at great returns. Like that this is the sequencing risk that really matters to us about how we're going to live a certain type of lifestyle in retirement. And I think that's what's great about the essay too. You're showing like what the actual income difference is. I think if I recall correctly, it can be anywhere from like 30,000 to 150,000, depending on the sequencing of those returns on what are your lifestyle costs like in retirement that you can safely withdraw at that alleged 4% rate. I mean, that's vastly different lifestyle between 30,000 and 120,000 these days.
Yeah. And I mean, I think what's interesting here is like, we're not, I don't know, people make moral judgments. Like this is the same person
Right.
with the
Right.
same intelligence level, making the same reasonable decision of like, I'm saving this much money. And yeah, I think that I did. If you take the 34-year-old scenario I gave, in the good scenario where they get the returns late, so they're able to build up a capital base, they're, if you want to calculate their safe withdrawal rate, it's $134,000 a year approximately, which is pretty, yeah, you can live a pretty nice life on $134,000 a year. And the alternate scenario, same person, works just as hard, saves just as diligently. The outcome is $36,500 a year is their safe withdrawal rate, right? So a very different outcome than this 134 thousand scenario. And I think as we talked about earlier in the previous podcast, like you do not get the average returns of the market, right? You don't know, we don't know what the future average returns are, but let's just say we do. If you don't know the sequence of those returns, you can have very different outcomes unless you're doing something, around how the portfolio is constructed to try and reduce that sequencing risk, right? To try and to make the returns more consistent over time.
Right. We're also not trying to create a generational argument, and we can just use ourselves as proxies to put a finer point on it. But I remember when a conversation you and I had years ago, you're like, what was me when I, graduated college like into 2008, 2009, right? There's no jobs available. And I'm like, yeah, that part sucks. But as soon as you get a job and start investing in assets, you're investing at the nadir, and you likely have a run ahead of you, even though we don't know the future, right? And then I think about like I was born in 78. So like people in mind, like getting out of college 2000, 2001, going through the dot-com bust into 9/11, right? And then like for me, commercial real estate, let's say I start buying my first properties in 01, 02, you get a 5-6 year run of building up assets. And then all of a sudden real estate completely collapses. We go into like the biggest recession, or depression in 100 years. And it's like it really matters like how lucky you get on that sequencing risk. And I was even talking to a friend of ours, a mutual friend of ours the other day, and he was talking about, he was in, not high frequency trading, but similar, like, a lot of like really technologically advanced options trading. And he was talking about kids now that they're asking him for advice, and they're probably going to lose their jobs to AI and to all these other things. And he had a great 20-year kind of bull run, is like, just hit that sweet spot. Like, like that's what we're like trying to say, is like, you can get lucky or unlucky. And we always think about portfolio construction via ergodicity because we're just trying to reduce the luck. We're trying
Reduce
to
the
like
impact of luck.
right. Yeah, exactly. Reduce the impact of luck. Where I feel like a lot of people's portfolios, it's a lot of luck involved, and they're hoping for good luck. And we're like, we're just not, maybe we're just not that optimistic or hopeful. I don't know. Like we're just trying to reduce the bands or the opportunities where bad luck can hurt us, I guess is a good way of saying it.
Yeah. And I think, I think there's something that's not entirely intuitive as well. I had a phone call with someone earlier this week, and they showed me some pie chart of like how wealthy people are invested or whatever. And they're like, oh, look, this is how you should be invested because this is how wealthy people are invested. I was like, well, maybe, but like, by definition, whatever did the best over the last 10 or 20-year period is what all the wealthy people will have, right? And does that indicate it's going to do the best over the next 10 or 20-year period? No, like at any given point in time, if you just take a snapshot of whatever, arbitrary, whatever the wealthiest people are, right? It's going to be whatever went up the most in the last, the previous time period over the last 10 or 20 years. So I think, last time we talked about sort of longer run return stuff, and we do try to take that historical view. And I think that's important. But as you say, like, how can you, we don't know the future. We don't know the sequence. We don't believe we can predict that. With that, sort of what is the best way to think about portfolio construction. So we'll talk more about that. We got some fun topics coming up: volatility drag, a riff on Herschel Walker, and more. So stick around. We'll be back.
That was great to learn about the great train robbery. So we'll leave that out there. That was a great one to learn about. So dangle that carrot.
This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Mutiny Fund, their affiliates, or companies featured. Due to industry regulations, participants of this podcast are instructed to not make specific trade recommendations nor reference past or potential profits. Listeners are reminded that managed futures, commodity trading, forex trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they're not suitable for all investors, and you should not rely on any of the information as a substitute for the exercise of your own skill and judgment in making a decision on the appropriateness of such investments. Visit mutinyfund.com/disclaimer for more information.